My name's Lauren. I'm Director of Consumer Insights and Propositions at Fair for All Finance. Why consumer insights and propositions together? We know that some of the most successful companies in the world are really good because they get to the heart of what their customers need, and then they deliver products and services that meet those needs. And I think we need to be applying that same mindset when we're talking about financial inclusion, when we're talking about solutions that will help people build financial resilience. These are hard problems to solve, and that's why it's great to be in such a packed room with brilliant people who are all here to solve those problems together. So we're going to talk about the updated Fair for All Finance segmentation of people in financially vulnerable circumstances. We'll talk about changes and trends in the segments, and then with my panel we'll be talking about how we've used the segmentation and how other organisations have as well to drive change. But if you're thinking, what is segmentation? What's she talking about? Segmentation is a way of grouping together people with similar needs and characteristics so we can really understand those needs and design products and services that work for them. And what we're talking about when we talk about people in financially vulnerable circumstances is 20.3 million people. Over 20 million people. For people who in this room who know our segmentation from before, you'll remember that only a couple of years ago this was 17.5 million people. So an increase of almost 3 million in only a couple of years. This isn't just a massive challenge when we're talking about financial resilience and financial inclusion. It's also a big commercial opportunity for those who like to see the world in that way. This is a massive market to serve and a massive opportunity for us to get together and think about how do we build financial resilience for this audience? What do we need to do differently to serve the needs of these 20.3 million people? These are our six different segments of people in financially vulnerable circumstances. On the right-hand side, we've got our two most financially vulnerable segments, so credit crisis families and forgotten families. That's nearly 8 million people in total. The big difference between the two, credit crisis families are really in a cycle of using all sources of credit that they can. Still very, very difficult for them to access credit. Many people in social housing, more people who are single parents. Forgotten families, similar social housing, similar very low incomes, very low levels of savings. What we see the difference is here is less likely to be using sources of credit in any form. Sadly, what we see is still sources of debt, benefits overpayments, behind on council tax, behind on rents. So even though they're not choosing credit, can end up in that cycle of debt. Coming over to the difficult debts. Difficult debts are reasonable incomes, some of them households with over 50,000 of income, high levels of debt as well. In the middle, we've got a mixture of segments. So at the very top, ungolden years are a pre- and post-retired segment. So there's almost two groups within this. People with low and stable incomes and those who've already retired. Squeezed and sliding, our biggest segment. This is almost a mass market segment. So think renters and homeowners, kids, housing costs, childcare costs, kind of 30k-ish incomes. Those of them who'd built savings during the pandemic have really got through those and depleted them, which is putting them in an increasingly precarious and vulnerable position. And then unsteady starters, finally, our smallest segment, 1.9 million, 18 to 30-year-olds, many private renters, many people on 0 hours contracts, and kind of experiencing that income volatility, which can make accessing products really hard. And what we've seen in that 20.3 million is actually the growth is in the kind of more precarious groups. This is the silver lining of the presentation I'm giving today. Most of the 3 million is in difficult debts, squeeze and sliding, and unsteady starters. And what that means is it's easier to do something about it. We can go away after today talking about building financial inclusion together and do something in our organisations to make those numbers smaller, which is a good news story to be taking away. While the growth is at the more precarious end, the depth of vulnerability is worsening for credit crisis families and forgotten families. We're not seeing massive number changes, but these are segments who were already choosing between heating or eating 3 years ago, 4 years ago. We know inflation's only got worse. We know it's only making it harder for them. It's increasingly hard to find solutions to serve this group, which is why it's going to take more collaboration, more different thinking, more working together to make sure we've got solutions to serve them. I'm just going to talk about some of the key themes. So what do we know about the segments? We've got 6 million people with no savings. 6 million is a huge number. It's an easy number just to say out loud, 6 million with no savings. What we're seeing is difficult debts. They were the segment with the biggest growth. As I said, the people who are new in are more precarious. So it makes sense that the people with no savings has gone down slightly. The block colours are the new numbers, the dotted lines are the old numbers. Ungolden years, really worrying, almost as high as credit crisis families, people with no savings. And as I said, these are a group where most people are going to struggle to earn more. They're at a point in life where they're going to struggle to build that savings pot up. So particularly vulnerable for those with no savings in this segment. And then credit crisis families and forgotten families, again, not a massive growth, huge numbers, half in forgotten families with no savings whatsoever. There's a massive problem with resilience here. And when we think about resilience, we talk about savings and insurance. It's no surprise, really, that there's a gap in insurance. I think anyone would have said we'd expect to see insurance under for the segments. So orange is the segment average, grey is the UK adults in total. Big gaps in contents and buildings insurance. We know that most people in the segment are private renters. There's a lot of people with mortgages as well as people in social housing. So really putting themselves at risk of events without the savings to fall back on, potentially without credit to use as well. We've got a big resilience issue. A slight point on gadget insurance, even though the numbers are low, interestingly we see for the most financially vulnerable segments, we will see them over-index on gadget insurance. So we know that people are willing to buy policies that protect the things that are most important to them. We also know that they might not always be the best value compared to contents insurance or home insurance policy. So there's something there in how can we make sure that products and services are giving people the value that they want. And credit, we talk a lot about credit as part of the solution and financial resilience. Interestingly, a big gap on credit card. People in our segments less likely to be able to access and use credit cards, much more likely at this right-hand side to be borrowing from family and friends. So twice as likely as the UK average to be using this source of informal lending. We know that people's family and friends are generally in similar financial circumstances as well. So it's not just the people who are lending the money, it's the people who are borrowing and lending who are both potentially financially vulnerable through this. And when we look at credit, it's a particularly interesting one to look segment specific. So this is credit crisis families. For credit crisis families, 1 in 3 are declined for credit when they apply, compared to 1 in 5 across the segments overall. And then what they do when they're declined for credit is different. So borrowing from family and friends, as you'd expect, is high. Going without the item or service, and this includes essential items, cookers, fridges, furniture for the home, for kids, etc. Going without those essential items and services, we see a lot. And of course, less likely to cut back on discretionary spending because there isn't any discretionary spending to cut back on, and less likely to use their savings because there's no savings there as well. So we know that for people in the more vulnerable segments, when they are declined for credit, when that market isn't there, the alternatives can be pretty dire as well. And I know that many of you in this room will have spent a lot of time thinking about the consumer duty over the last couple of years. We wanted to map the segments to the 4 FCA definitions of vulnerability. And what we see overwhelmingly is that low financial resilience is the category that most people fall into. So 68% low resilience, only 1 in 5 low capability. Those of you who kind of interact with these customers regularly, we've heard a lot how great people are at budgeting. People on low incomes have to be really brilliant at budgeting because they've got no alternative but to do that. So it's the resilience that we want to be focusing on. How do we build resilience for people? What do those propositions and services need to look like? How do we do that together? And interestingly, over 50% of people in the segments will fall into 2 or more categories as well. So it's complex groups, complex needs for us to tackle. How do we do this? How do we kind of share ideas, share best practice, and do this together? So this shows for each of the segments where the focus areas are needed across credit, savings, insurance, income maximisation. As you'd expect, credit crisis families, forgotten families are showing as red. We've got work to do across almost all product areas to really make a difference. Now, the cross-cutting one of savings, we've seen how many people, 6 million with no savings across those segments. There's big opportunities here. And on the right-hand side, we've just covered some of the areas Fair for All Finance is already looking at, and work that I know other people in this room and outside of it have been doing for a long time on what solutions can look like for people in financially vulnerable circumstances. I'm going to ask my panel to join me and we can talk a bit more about what this looks like in reality and what organisations are doing.
It's great to see so many of you in the room. I know many of you have already seen the segmentation research before, some of you are seeing it for the first time. The group is not a monolith group. They have different needs, they have different expectations. If you think about the unsteady starters and the ungolden years as an example, you would expect that they had really different expectations of what would help them in their financial life and journey. And that has really helped us bring it to life. We've worked with organisations all across the sector, so community finance, banks, building societies, insurers, and trade bodies like the ABI, the Association for British Insurers, and many other organisations. So there's no one-size-fits-all, both for our customers, but also for the organisations in terms of where they are on their financial inclusion journey. So we've done a number of things to partner with the financial services industry. We have done workshops that look at specific segments to look at potential propositions and ways of supporting those segments. We've spent days formulating strategy and thinking about what that means for that organisation in terms of the way that they address financial inclusion. So there's lots and lots of really exciting things that are happening in that space. I would say to anyone who hasn't already, do take a look at the segmentation research. It can really do wonders to complementing your existing work that you've already done, and now is the time to look at this work if you haven't already. There's some really exciting things happening in the proposition space, and I know that Kate and Laura will both be talking to us in a little bit more detail about some of the exciting things that we're doing. But today, I guess if I could have one call to action for many of you in the room, we know that really good progress has been made on current accounts and access to banking, and we know from our data on the segments that even the more vulnerable customer segments like forgotten families and credit crisis families bank with the mainstream providers and sometimes challenger banks too. So one thing that you could do today is think about how could you integrate benefit and grant calculators into the onboarding journeys for those customers and signpost them to that support. It's no secret, or I hope it hasn't been, that there's 19 billion of unclaimed benefits in the UK that people are not getting access to. For me, this is one of the areas where there is really clear mutual benefit. For you as a financial services provider, that customer is no longer in a profit loss-making product. And for the customer, they've gained impact from getting access to additional income. So it feels like a big win-win.
Great, and I think it's fair to say in the first round of data, we found something like over 85%, over 90% of people in the segments had a current account with a mainstream provider. We're digging out the insights from the new data, but as you said, these are people who are already being served. Yeah, it's not going after new audiences. They're already there. So if they're underserved in your customer books, how can we do more about it?
Absolutely. And just to kind of finish off, if you think about the number of people, 20 million people, that's larger than the population of the Netherlands. If someone told you that there is a market opportunity of 20 million people that you can serve, and you already have the infrastructure, the channels, and the regulatory permissions to do so, it would feel like an opportunity too big to miss out on, and I think we just need to twist our thinking on its head for that.
The No Interest Loan Scheme we've been running with grateful thanks to Treasury, JP Morgan, the devolved administrations for their funding, and to Toynbee Hall and Fair by Design for their help in co-designing and getting it going. We've got roughly 7 lenders delivering across the UK, and we've now had over 10,000 loans issued with an average value of about £700. And the segmentation model has been really helpful in refining our targeting process and our eligibility requirements to make sure that the loans are reaching the people that the No Interest Loan Scheme was set up to serve. And in particular, really kind of refining who within those segments we're looking at. So in particular, we've been able to reshape some of the criteria that lenders are using to make sure that we're getting the loans to the people who need them most. Because the construct for a no interest loan was basically about giving someone a loan in an emergency situation where getting them that access to credit was going to make a difference, both to their lives, but potentially for the way that they could contribute to society. And that construct is obviously quite a delicate one to land. So it's been a really useful set of data and analytics to help us with that.
And when we set out, we I guess had the hypothesis that it would be people who are being declined for credit in both creditworthiness and affordability. And I think as we've mapped that, we've seen differences in those learnings, haven't we?
Yeah, and I think that's probably one of the bigger pivots. So Treasury funded a feasibility study many years ago now, which essentially focused only on taking the interest off and how many people would be able to get a loan if that cost of the loan was reduced by the interest. And what we did through the design stage was realise that that wasn't the only thing that was stopping people from connecting to that loan, and that what was sitting in their credit file was often a problem, but might have been a problem some time ago, and there wasn't really an opportunity to retest if it still was. So the bad debt guarantee that scheme has been enabled with has really let lenders say yes in a context where they wanted to help someone, for example, repair the car so that they could get to the job, pay the nursery fees up front so that they could start a job, cover the funeral expenses in the midst of a tragedy. So really important use cases. And that kind of flip of what we were expecting from a feasibility study that said it will entirely be about dropping the interest to what we've seen in practice, where the majority of those loans are actually being approved for a credit risk reason, where the bad debt guarantee has made the difference. I think that's a really interesting insight in terms of what's the barrier to connecting people to really small but vital sums of credit at a really crisis moment in their lives.
And some of the learnings, both from the no interest loan scheme and from the segmentation, we've taken through into the new consolidation lending pilot.
Yeah, the feedback that we had about NILS was that for lenders it was a really scary thing to be offering a loan to someone who they were declining, where the whole population was in a crisis and essentially in emergency circumstances. So for the consolidation lending pilots, what we've tried to do is delineate two populations: customers who are just outside lenders' current tolerance, and for lots of credit risk people, that's always been the question, hasn't it? What would have happened if I said yes? And having a bit of commercial buffer to be able to say yes is the heart of what we've called Population A. Population B are people with really difficult debts and problem circumstances, where if the cost of that debt was significantly reduced, they'd be in massively better circumstances. And by blending those two groups, we've just changed the way that we're framing it to make it much more balanced from a risk perspective, but from our perspective, still trying to reach two groups within the segments that are really important to serve and serve well.
It's really just the starting point. There was a slide up earlier, which you can go to, where we highlighted some of the product gaps we see, but that was at a really high level. So it's really, the next stage is kind of trying to scratch beneath the surface a lot more. And with that, we kind of advocate a co-design approach. I know a lot of organizations will be getting user feedback. They'll also be listening to a lot of seldom heard voices, but trying to do that in a way that gives people a lot more comfort to talk openly about the products and services they want to see is kind of the most useful way to build up a kind of deeper picture of what is the opportunity that you can serve.
And recently you've been doing some co-design work with the Nest Insights team on the Real Accounts project. I don't know if there's anything you can share from there, kind of early learnings that might be useful for anyone thinking about proposition design.
Yeah, it's been a really interesting piece of work to do with the Nest Insights team, and it also builds on some earlier work they've been doing with households, looking at kind of their transactions history as well as interviews. So they've really been able to build up that trust over a period of time, which meant that it was we were able to get really deep insights with a number of households to these segments. And there were quite a few key themes that came across. So the first, and I should say, in these workshops, we're really asking people from our segments to design a product that would work for them in terms of access to credit, both in terms of fixed loans and buy now, pay later type services. And the first thing that really came across is, for them, responsible credit is around how do you provide credit and savings at the same time. And with that, it wasn't around how can I get necessarily return on my savings, but it was thinking through the pendulum of credit and savings being a tool to manage money on kind of two flip sides. So I need time when maybe my income is higher to be able to put more away so that then I can kind of reduce kind of my dependency on credit. So it was really, how can you be a brand I trust by preventing me getting to that ongoing kind of spiral of usage of your services, but feel like you've actually got my back. So that was kind of the first learning. The second piece was people were really keen to have more transparency on how products worked up front to be able to access that. And it was much more than, I think, I would have thought going into the session. So people really wanted to know what would happen during a product's life cycle. So what happens if I can't make up the repayments? They really wanted to understand the detail of what happened throughout the whole life cycle, and have a lot more visual information at that point in time to be able to easily kind of compare and understand. And then another kind of key theme that came out was around impulse purchases. So as Lauren said, a lot of customers know how to budget really well, but where they get really nervous is around those rewards that they want to get for their family, they want to maybe get for themselves, but they see that as a challenging point. Like, should I use credit for this? Should I not? How does that impact my decisions across the year? And so that's where people really almost wanted a check-in point, almost some kind of buddy or accountability stage that they can understand and kind of navigate what the options were for them. A little bit of extra guidance of what to do to try and help manage any kind of impulse purchases. And I would just say to that, we did test a number of different features that could work around that, and they were pretty much all like Marmite. Some people loved them, some people hated them. So it really talked to that kind of that adage of like one size doesn't fit all, which is not very helpful from a propositions perspective when they are kind of so bipolarizing. But where the consensus is everyone wanted that time just to set up the guardrails that would work for them. So it was just how, as a service provider, can you provide that personalization up front to put in a few different guardrails that customers can choose from, which would work for them.